Imagine this: you've been saving for years, watching the Canadian housing market soar beyond your reach. And just as you're about to give up, you hear the words every buyer dreams of: prices are falling. That's exactly the reality in 2025. After years of record-breaking price hikes, bidding wars, and desperate home buyers, the tide is finally turning, at least for now. But before you pop the champagne, this price drop comes with its own set of challenges and opportunities. The big picture. According to recent market forecasts, Canadian home prices are expected to drop by around 2% nationwide in 2025. On the surface, that might not sound like much, but when you're dealing with 6- or 7-figure home values, even a small percentage can mean tens of thousands of dollars. However, the drop isn't evenly spread across the country. Toronto is projected to see prices fall by about 4%, Vancouver by 2%, while some regions, particularly Alberta and Atlantic Canada, are still showing resilience and even modest growth. Why prices are cooling. The reasons behind the softening market are layered, but the headline culprit is the ongoing US-Canada trade war, which has shaken economic stability and hit consumer confidence. Add to that the high interest rates of the last 2 years, reduced foreign investment, and stricter mortgage stress tests, and you get a market where buyers are hesitant to commit and sellers are adjusting expectations. Other contributing factors include slowing immigration growth rates compared to the post-pandemic boom years, increased housing supply from both new construction completions and investors offloading properties, cooling rental markets in certain cities, such as Calgary, where rents are declining and easing pressure on buyers to rush into ownership. The regional breakdown. 1. Toronto, GTA. The GTA is experiencing a noticeable price dip around 4% expected by year-end. For years, Toronto's market was fueled by fierce competition and low inventory, but the combination of higher borrowing costs and economic uncertainty has cooled demand. Some buyers are finding rare opportunities to purchase without bidding wars, something almost unheard of in the last decade. 2. Vancouver. Vancouver's market is forecast to decline by 2%, but the drop is cushioned by continued foreign interest, limited land availability, and ongoing population growth. While affordability is still a major challenge, even a small dip gives some buyers hope. 3. Calgary. In contrast, Calgary's sales activity remains relatively strong, though rental prices are falling. Investors are watching closely, as declining rents can eventually influence property values. But for now, Calgary remains more affordable compared to Ontario and BC for Atlantic Canada. Halifax, Moncton, and Charlottetown are showing stability and, in some cases, slight price increases. The affordability advantage over central Canada continues to attract buyers, including retirees and remote workers seeking a better quality of life. Winners and losers in a cooling market. Winners. First-time buyers who have been priced out for years now have a chance to negotiate better deals. Investors with cash reserves can capitalize on lower prices without worrying about high financing costs. Upsizers who sell in a softer market and buy bigger in the same conditions can still come out ahead. Losers. Recent buyers who purchased at the market peak may face negative equity. Over-leveraged investors relying on high rents to cover mortgage costs could feel the pinch as rental demand softens. Sellers who expected bidding wars may need to adjust their timelines and price expectations. Opportunities in a downturn. A falling market isn't necessarily a bad thing, it's a shift. Historically, Canadian housing has shown resilience and rebounded from downturns, often stronger than before. For those with a long-term view, 2025 could be the moment to secure properties at more reasonable prices. Key strategies. Lock in financing now if interest rates are expected to drop in the near future, allowing you to refinance later. Negotiate aggressively, as sellers are more open to concessions like covering closing costs or including upgrades. Focus on fundamentals: good locations, solid infrastructure, and growing local economies tend to recover faster. Risks to watch. Even with prices dipping, risks remain. If the trade war escalates, the economy could slow further, putting more downward pressure on housing. Interest rate fluctuations could affect affordability in unexpected ways. Unemployment spikes in certain industries could dampen housing demand more than forecast. What comes next? Most economists believe this isn't a market crash, but rather a short-term correction. With supply challenges still present and immigration policies likely to support population growth, demand could pick back up in the coming years. The key is to see this moment as part of a longer real estate cycle, not the end of one. Final thoughts. Your move in 2025. Whether you're a first-time buyer, a seasoned investor, or a homeowner wondering what your property is worth, the current market shift is a reminder that real estate is never a straight line. In 2025, patience and strategy matter more than panic or FOMO. Now the question is, how will you play this market? Will you hold back, waiting for a bigger drop, or seize the moment to make a calculated move? Let's hear your thoughts. If prices keep falling, will you jump in or stay on the sidelines? Drop your take in the comments, and let's talk strategy.